Hello, Wyckoff Nation and our guests. Today we have an open door class of the Wyckoff Trading course, part 1. As always, everything that we discuss in our classes is for educational purposes only. Please stop the recording and read the disclaimer in full. And obviously, I want to suggest that after attending this class, you consider signing up for this course. As this is a foundational course, this is our flagship course, where we discuss what seems to be the fundamentals of how to read the chart from the Wyckoffian point of view, and obviously how do we apply the tactics that is relevant to the specific situation. And I'm going to show you quite a lot of example of how we convert knowledge into skill and into execution and to the results. So I definitely also gonna engage you guys, especially the guests, not just the students that are attending this session as well, but you. I want to ask you the question, what's not working in your trading? So why don't we have that type of discussion, right? And we'll try to figure it out together. Okay, but so far, I want to concentrate on the course itself, just to get the information out there. So we're going to have 15 sessions. And for those of you who would like to have some recurring monthly payments, you could still do that. This is a very popular feature for us, so go for that. Also, a very common question that is being asked during the sessions is this session being recorded? Yes, it is. And we will be posting this video tonight on the Wyckoff Trading Method YouTube channel, so you could check it out. If you have to go, no problem. You'll see this recording, and then obviously go to our website, wyckoffanalytics.com, and register for the course. I'm looking forward to working with you. If you have any questions about the course, please contact Nancy at info@wyckoffanalytics.com, and she'll gladly help you. For those of you who are already students, you're going to have a homework. And the way how I want to address the homework is, and we'll talk more about this in the second session, but I want you to send me just one file per homework. It's either should be a PowerPoint, PDF, or the doc format. If you're sending me a zip file with multiple charts, then I have to go from one chart to another, and it just takes time. It's not efficient. And I want to go through all of your homeworks. Also, please specify, again, I'm talking to the students, so for those of you who's going to sign up and you're going to send me your homework files, your first name, the first letter of the last name, the class, and the homework number. And you could send it all to wyckoffsociates@gmail.com. I'll be able to go through all of them before the next class. All right, so we're going to address this from different perspectives. First of all, for those of you who are guests, let's just answer some simple questions. What is the Wyckoff method? It's a body of the technical analysis that concentrates on the identification of the dominant force, whether it's supply or demand, sell and or buy, and the effects of that dominant force on the price action. Those are going to be driven mostly by institutional investors and traders. Retail traders will have an upper hand very occasionally, but mostly it's the institutions that drive the price structure and the trends. Does Wyckoff method work? Yes, it does. So it's Wyckoff method is based on the principles of how off the chart, we could understand what is in control, buyers or sellers. And once we see that through the chart, we could follow the dominant force, institutional dominant force, alongside of the trend, or maybe even a trading range, but we know exactly how to trade that. So with that, usually the major last obstacle is always going to be the ability of the trader, to get to that level of accuracy and efficiency and profitability to become a consistently successful trader. And I will show you some of the results, so stick around. I will show you some of my own trades, so stick around for that. But for now, I kind of very curious, who do we have as a group? And I want to engage with you a little bit. I want to ask you the question, what is not working in your trading right now? Could we talk about that? Could you just write down in the questions box some of the issues that you have currently with your trading, and I will try to quickly address some. Ali is saying knowledge. Okay, well, Ali, how about this? I'm going to be a little bit controversial here. When you say knowledge, I'm going to say that in some cases, indeed, if you're a true beginner, you need to have the knowledge on how the market works. I'd say if you're an intermediate level trader, this means that you already have the knowledge. And I see that in a lot of people and in myself as well. Sometimes we start hoarding the knowledge, right? We want to know more. But do we have enough knowledge to be consistently profitable? Yes. Maybe there is something else is lacking there if you're already at that level. And I don't know exactly at which level you are, Lee, so I'm just giving you different options here. What if you know already and you just need to practice that knowledge? How about that, as a concept? Discipline is saying, Neil, okay, well, it seems to be like a very, very common answer, right? Discipline. It's almost like one of the first ones that people usually say, like, I need more discipline. I would say that discipline comes from the ecosystem that you have built around trading. So this means a very cohesive approach to everything. The knowledge, the skill building, the simulations, the process, the way how you approach each day, each week. And that's what I call the system. And, that system would include also the classes, coaching, kind of like this reflective feedback, back and forth, adjustments. And it will take some time to develop that type of discipline. But the discipline never could be created, or maybe occasionally I would see like extraordinary people who are capable of creating the system and sticking to that. Usually, like 80% of the people, like majority of the people, are gonna fail somewhere in some areas. So what I usually suggest about the discipline, and it's not like you don't have it, you should have it, but it comes from being in the system that allows you to address all of the aspects of trading, from the trading plan to visual backtesting to simulation to the process. How do you do the watch list, position list, variance, post-trade analysis, feedback loop? All of that needs to be there. All right. So to me, this is a more complex issue than just like, oh, am I doing this or not? Paul is saying not having conviction, right? So no conviction. Okay, I think that if a couple of scenarios, if your trading plan is successful, is profitable, and you have no conviction, then you go and you practice. And there is a specific way how I would teach you how to practice. If you have no conviction and you don't have the trading plan that is back tested, then you have to develop this as the first step, right? So go develop the trading plan, do the visual back testing, create the simulation practice environment, get some coaching, that is on the level that you need, and go from there. How to identify good trades, entries, and exits from James. So I would say like selection. Okay, I would have to be James to be a little bit more specific, right? What market, what assets, what time frames. This is not just a very linear kind of like, question, but I'm gonna just assume stocks. So with that, this is a big subject in terms of selection itself. How do we do this? Obviously, we're gonna do some filtering first. This could be based on the comparative relative performance, price structure, supply demand signatures, and so on and so forth. So there are several criteria for the selection. Obviously, behind all of that, at point zero, you're still thinking about the market. That's your kind of like the base ground from which you launch all of your trading. You have to be in line with the market, with the institutions. Then after that, selection could go on a slightly different twist, and you could have a predetermined selection, the one that you don't have to worry about. If you're trading futures, there you would have to look at the correlation between the assets to determine your selection. If you're trading cryptos, you would have to be closer to the selection that you do for the stocks, something similar. And by the way, we have unbelievable expert on the cryptos, Alessio Rutigliano, and he has a Discord group. So for those of you who are crypto traders, check it out. And there is definitely a lot that could go into this conversation. In terms of the interests themselves, obviously you want to have, what I call a playbook of your entries, your exits, your add-ons, your trims, your sizing, your stop loss movement, which is going to be based on the strength of the specific pattern, on the higher or lower probability of that pattern occurring in the different contextual environments. So again, such a big topic, and this is something that we're definitely discussing in the classes. Lack of risk management. Okay, so risk management. Again, to me, and this comes from Raven, I'd say it's all about being in the system, developing that discipline. It's not that difficult to maintain that risk management once you are not allowed, to do bad decisions, right? So, and I'm talking obviously from the perspective of, the training that we have. And to trade too early. Okay, well, this is just, some adjustments that need to be made. From Gabriela, my selection of stocks timing has been horrible for the last 3 months with a very low win rate. Again, selection here will have to see exactly which portion of that needs to be adjusted, right? Whether it's just filtering itself or whether it's just filtering based on the price structure or on the supply and demand. Timing when to enter and exit the trade from Jim. Yeah, timing is a pretty significant measurement of accuracy and efficiency of the trade. And there are definitive ways of thinking about timing. It could be related to the specific bar events. It could be related to the specific setup events. It's something that we are developing this semester in WTC2 class. So if you stick around, by the time you get into WTC2, we'll definitely talk about that. Looking for a good structured method to understand the markets, the ups and downs that occur on a daily basis from Roy. Roy, if after this session you feel some kind of synergy with the material, explore that. One way or another, you can't really go wrong with taking those courses because it's just fundamental and so foundational to understand how do you read the chart, how do you see the force behind what's going on in the market. So whatever methodology you use, you could say I'm an Elliottian, I use Elliott wave method, and I still would say take our course just for you to develop a much deeper understanding into the volume and effort relationship with the price. Believe in your trading placing correct stop losses from Shiwan. Yeah, so that's just an element of the system. I don't want a black box system. I'm looking for deeper understanding of the markets, Roy. So then, yeah, this is it. This is the class for you. Analysis paralysis. So I've been developing a lot of verbal algorithms for students and for traders, and literally we are practicing and training them in real time as it happens. I mean, I literally have trading sessions with students where they trade and I'm sitting by their side and I'm just literally listening to their logic and correcting it in real time. So this analysis paralysis, Eric, only can be overcome like that. Where you have like this, constant feedback, and you just change. Bar chart understanding and interpretation need from Brian. Yeah, that's exactly what we do. So stick around, be here. How to overcome day trading, FOMO, posting huge gains, can only trade part-time. James, again, this is just, like some kind of like approach to trading itself. We have quite a few traders who kind of got to a very, very high level, but that high level gives you a glimpse into what is possible at that like very, very, very high level. So let me just kind of like jump to this. We started the company as an educational company, and our goal was to educate traders around the world on Wyckoff methodology. So we've created a big body of knowledge on Wyckoff method. We've actually deepened and extended the knowledge of Wyckoff methodology further and further into like understanding of what we're seeing on the chart. So I'm really, really happy with where we are on that. And still, this material is being developed. Then we've realized that knowledge is not a skill, as I usually say. You have to create the skills, behind the pattern recognition, execution skills, and mental changes skills as well. So with that, WTC2 is that continuation step where from knowledge step, I'm transitioning you into the skill building step, and you're starting your training. And after that, we realized that you have to have specific process as to how you go about your trading. And you have to have a specific system, the ecosystem that you create around trading. And that's going to concern everything. So usually the things that are going to be discussed: trading plan, back testing, practice, journaling, variance, feedback, coaching, and all of that. So you kind of get into that deeper and deeper and deeper, and you start dissecting all of your mistakes, all of your problems in trading, and we start correcting them one by one, and we're starting to see whether you're like relapsing on accepting it, and so on and so forth. Obviously, at that level, or at the higher level, mindset becomes a very, very big part of trading. So anything on the self-awareness, on the feedback, it would produce, some kind of behavioral changes. So as a company, we had all of that, and we've been developing this for the last 12 years. Our company has been in existence for 12 years. Our big step in the change in our identity as the company is today. It's happening now. In the last semester, we launched a pilot program on intraday training, and it just took us by surprise how everything that we've been creating for 12 years up to this point is working. And people change, and people change their trading habits. And why does this happen? Because they are in the system where if they make a step to the left or step to the right, they are no longer in that program. And that creates such a disciplinarian environment where each member supports each other, and there is such an amazing group dynamic that the guys have. And obviously, the accountability to the process, constant feedback from coach, and that produces those behavioral changes. So training is, tires meeting the road. This is where we actually make the change. So if you want to be, become a very serious trader where it's not just a dream to make like $10,000, $20,000 per month, but it's something that you can commit to as a goal. And I must say that in a lot of cases, and this is what I learned from this program, traders usually underestimate the commitment that is needed for the consistent profitability. I'm just going to give you one example. For those of you who are not consistently profitable, this means automatically everything that you've been doing up to this point, or everything that you're doing right now, is not working correctly for you to be that consistently profitable. Think about that statement. Everything that you're doing right now is not working if you're not consistently profitable. Maybe something is working. Maybe analysis is working, execution doesn't work. Maybe you have a good execution skills, but the system is not there. Maybe you have a system, but there is no immediate, and consistent and high quality feedback from coaching. So there could be a lot of elements that are missing, and I would have to look into, specificity of your problems to understand like what advice to give you. And it's not just me, but we have a whole team of experts that you could employ, and you could hire any coaches that we have. We have a process coach, Franz. It's just like such a great manager, has so much knowledge now on how to create trading plans, how to backtest them, how to build the your environment, your ecosystem. And then obviously you talk about somebody like Bruce or Alessio, they just have so much experience in different fields. So don't underestimate the value of the feedback. It moves you faster to your goals. I also see that traders usually overestimate their skills in analysis and trading. We're usually a very, very smart community. Our methodology attracts very smart people, kind of like this more contrarian thinkers, where an intelligent risk taking is acceptable, and it makes sense to us, right? So we want to estimate our odds and then we want to act on them. But that type of also being smart sometimes produces the ego overtaken and just overestimation of the skills. I have not met enough traders, probably like I could use one hand, where I would say like, wow, the skill is so high. And by that I mean like technical and mental skill. So with that, like I'd say like we all need to develop our skills more. Traders often neglect to view trading as the craft and as a business that can support the living. So it's such a dogmatic statement, but when you're in it, like when you're in the business of changing people's trading, and then when you see the changes and you see that it's possible, and people are making that 10-20,000 per month, I mean you kind of like change your outlook on what's possible and not. So I'm going to tell you that I always thought it was possible for me personally, but then once we started coaching and training, I could say that yes, specific traders could make that type of money. It's going to take everyone different amount of effort and different amount of time, but the commitments that you're going to make are going to require some sacrifices such where you might have to spend like 50 to 70 hours a week on developing the skill. And if you can't make that type of commitment, it just like your progress is always going to be less speedier. Trading beliefs are always dogmatic, or in a lot of ways dogmatic. I absolutely dislike the beliefs of like, volume needs to confirm, like volume, let's just say, confirms the price, or you need to diversify, or you need to always have the same type of risk on all of the trades, and so on and so forth. So those are dogmas that were created to protect the retail community from trading in a speculative way. And for those of you who are low risk aversion, I absolutely suggest that you do exactly that. For those of you who could develop the skill to a very high level, and the skill of what? The skill of recognition and execution and mental adjustments at the same time, then your strategies change at that point. Then you start thinking more like George Soros, being a pig, or like Paul Tudor Jones. When you have an opportunity, you go for that. Like it's a completely different mentality. Awareness of choice in the moment is possible. So that's the highest moment of awareness for me, when you recognize you're doing the wrong thing and you are capable of changing in the moment. So that's kind of like a goal, mental goal for the program. Restructuring negative talk is crucial to achieve that flow mental state. So we work with traders a lot on just staying in that flow mental state. It's extremely important to understand when your ego is coming out, and even when you listen to me, you listen to your self-talk, and sometimes you could recognize like, oh, it's an ego talking. So definitely something that we work on a lot. At the advanced trading level, the primary obstacle is only self, which is, I'm just seeing this not just from myself, but from other people now. Trading at a higher conscious level involves a continual process of self-reflection. This needs to be done on a daily basis and swift mental adjustments. So this is possible with coaching. Attaining inconceivable results like consistent super profitability is possible as well. I mentioned that achieving professional trading status, which involves making consistent living from trading, is challenging, and it demands significant mental time and financial commitment. But success in trading is a deliberate choice, and I truly believe in this, and is achievable for who commits properly. There are some limitations that some traders would have on their natural abilities and talents of how they see the market, how they see the chart, how that translation happens into the execution. That definitely is a big question that I would be asking as a coach. But this is something that we could only figure out in the process. Okay, well, I mentioned our intraday training module. So let's go through some of the results of the pilot that we had in October, November, December. And we have 6 traders. The 7th trader came, in the last day. So they just started there on the 2nd week of January right now, and we're just coming back. But before that, before the Christmas, what did we do? What kind of achievements these traders have done? And by the way, please keep in mind that all of these traders came from the student body of our Wyckoff community here at wyckoffanalytics.com. I did not and I will not take any of the traders that are not members of our community. There are prerequisites for this program, and I want you just to understand that, if you want to go for something like this, where you want to drastically change your trading and your trading results, then commitment is not just enough. You have to go through the program. We have to train you to that moment in order for you to start enrolling. All right, well, let's look at the results. Trader number 1. So in 2 months, what has been achieved? 17-day streak of being profitable. Those are intraday traders, right? So for those of you who are intraday traders, you guys know, you strive to be profitable each day, each week, each day, and then your profitability depends on that. And then, some different things that this trader achieved that are meaningful to him and me, to the program itself. So we kind of like seeing how, for instance, like there is a high daily consistency, meaning that that streak of so many days in a row that defines that consistency, and we have specific measurements of that. Quick mental adjustments, less duration on being unconscious, very positive attitude. Trader number 2 achieved $1,000 day twice. So that was the goal. So he started with $150, $200, $300 per day, but was extremely profitable, was very consistent. So 40 out of 41 days, that trader was profitable. That was the streak. And then twice reached 1,000. What does it mean, 1,000 per day? 1,000 per day on average reaches $20,000 goal per month. So that's how we kind of like measuring the profitability. It's one of those measuring sticks for us. And then look at this: high daily consistency, high accuracy as well. We optimized, his trading identity during the program. He developed extreme self-awareness. Already had a lot of that, and then we started working on major kind of like mental improvements that would push this trader even to a higher level of profitability. So obviously that's going to be all in the sizing. Trader number 3, here we have a quantifiable, if I were talked about the quantifiable effects, 2 weeks of low daily consistency. And again, each trader, has to go through his or her own steps, milestones. And, I definitely see now how it's all progressive and it's all relates to the number of hours and the commitment that the trader has. So don't please kid yourself about that. If you're not making the money consistently, about what you're doing right now, clearly what you're doing right now is not something that produces this type of the results where you're having this type of streaks, or you're making that type of money. Trader number 4, we had 1 week of high consistency back at the pilot program. Some other good things were happening there. Trader number 5 hit $1,000 day, very high daily consistency, 20 out of 23 days profitable, made a return of 70% in a month and a half. So that was pretty cool. Very rapid mental changes, no weight on the past, stress-free. Trader number 6, we had first week of high consistently back in December, I believe. And these are the results, right? So you could see those are very individual, very different, but there is one trend here. If you commit, if you go through the painful days of self-assessment with each trade, and you take the feedback and you change, then you could do that and you could reach those goals that you have. I just want to plant that seed into your head. It's a possibility. So now that you know this, there are no excuses. There are no unconscious excuses not to be that. I've told you that, so you know that. And if you want that, then you definitely will find the way. What is the next session for the intraday training scheduled? We're gonna, start the new group somewhere in mid-October, August of 2024. There are quite a few prerequisites if you're gonna end up there, so you might as well just start, covering them up, all of them. You'll have to, complete a successful interview with me. Did I say no to anyone at the interview? Yes. So I don't want to waste your time and my time on something that is going to be really, really hard. So if I see that something is going to be like a huge resistance, then definitely I'll let you know, and we either discuss how to overcome this, or we just saying like maybe like another time. Yeah, and just like a huge commitment, in terms of the time, the cost. It's a very kind of like it's not a retail product per se, like in terms of scalability. There is no scalability here. It's so individual. It's just basically we dissect you in and out, all of your trading. So I'm kind of excited just seeing the results. So obviously we're in the second phase of this project. So for those of you who have any questions, email us, or for those of you who's going to jump into this, then make sure that you start going through the prerequisites, which this class is about. So, all right, so what are we going to cover today? Let's come back to our regular class. And I did promise you to show you some of my trades, so I will. So there's going to be a little bit further down this path. Okay, so session number 1, we went through the intro, some Q&As. The homework is going to be Jim Forte's Anatomy of the Trading Range article. I'll talk about this. I'll go through the market analysis really quickly just to show you what I think about the market. We'll talk about who Richard D. Wyckoff was and what he brought to us, what kind of thought about trading he left for us. We'll talk about the heuristic of the composite operator. Everything that we do is based on the price cycle model, so we'll discuss that, and then we'll go into the behavioral market analysis. this is the discussion about how different market participants produce the price structure and how we could show that and see that structure on the charts. Again, this session is being recorded, so I'll post it on YouTube. And I think everything else we've covered. Okay, so here is the homework for those of you who already signed up, and for those of you who's gonna sign up today or tomorrow. This is a mandatory read. Please read James Forte's Anatomy of the Trading Range. I consider this article to be the best article on price structural analysis. And there were so many attempts to rewrite this, to write this in a different way. And even though this is outdated, and I'm finding a lot of kind of like mistakes in this article, but still structurally, this is the best article to understand what Wyckoff methodology or specifically price structural analysis is about. So therefore, a mandatory read for those of you who are already students. Okay. All right, other questions? Does Wyckoff method work in the Forex market? And this is a very common question as well. And the answer to that is yes. You still go through the price cycle of accumulation, markup, distribution, markdown. You still look at the price structural analysis of the accumulations, distributions, reaccumulations, redistributions, uptrends, downtrends, swing up, swing down. And you still look at the character of how the price moves. You could use the volume, you don't have to use the volume. So it just depends. You could also do the comparative analysis of the correlated pairs, like for instance, US dollar, like euro and pound to the US dollar. Those are at times highly correlated, so you could use a comparative analysis right there. I've been a Forex trader myself. I started a trading career back in the 90s, with trading Forex. It just was not necessarily my time zone to do that because I'm on the West Coast in the US. And with that, it's not the most favorable time, to do that. But I definitely have a lot of knowledge on Forex as well. Can I use Wyckoff method for intraday trading? And yes, you look at everything. So price structure, character, volume, swing analysis, comparative analysis, PNF analysis, all of that could be used for the intraday trading. So absolutely, absolutely, you could apply this to intraday trading. All right, let's go through the market analysis. And my first question to you, and let's re-engage here again. What is the current trend? What do you guys think? Is it an uptrend? Is it a downtrend? Is it a trading range? Okay, uptrend, uptrend, up, up, up. Okay, anyone thinks that we're in the downtrend? Cecilia is thinking we're in the downtrend, okay? All right. Visually, on a very simplistic level, we could say that we have created a higher high, a higher low. If we go on the smaller time frame of the swings, bigger, larger swings, again, I'm seeing higher highs, higher lows. I'm seeing, in the immediate picture, an up channel, a linear regression channel, where I see clearly how all of the points around a meaningful support or the resistance or demand or the supply line have some emergence of the opposing force, and then we have some kind of reactions of those levels. So that defines the channel, the uptrending channel. I'm also seeing that in the middle, we have the area which we would call the mean of the channel, and that is also being respected in so many ways. So that conventionally suggests an uptrend. But I think that the correct question is more about what you should be asking me is which time frame? What are you asking me? Or or your answer should go something like this. Long term on the secular level, we are in the uptrend since 2009 secular low. And look at this long-term channel in the S&P. So 2009 low, COVID low confirms that, and then we have a bunch of overbought conditions associated with the specific, regimes and with specific tops, events, and so on and so forth. Look how we are honoring this mean of the channel. How many times have we done that? And every time we do that, we have that cyclical low of sorts. And the last cyclical low that we have had was in 2022. And of that, we are observing the Wyckoff pattern of the accumulation, and we've been commenting since last May of well, actually not the last May, but of the May of 2022, that we're going to go into the trading range that potentially could be a reaccumulation. And then as we started going through this trading range, and since I believe September, October of 2022, we started calling this as a bull market. I want to also say that we have so much support for you to gain this knowledge. I mean, literally every member of our team is driven by the question of how can we help you? How can we help you to get the knowledge that's going to be the best knowledge for you, that could be converted into the profitable execution? And again, if you feel some kind of synergy, usually the first session, it kind of gets you. And you know that this is where you need to be. So I'm looking for those type of people where you have such a compatibility with the conceptual representation of the Wyckoff method that you are willing to step into this and start studying and start applying it in your trading. Having said this, obviously for other traders, it's still good to learn different methodologies. I mean, like, I remember when in the 90s, I started studying technical analysis. I spent, several years just studying technical analysis and trading at the same time. I studied different methodologies. I studied Elliott wave, I studied Gann, I studied Wyckoff, I studied Dow theory, I studied conventional technical analysis, and a lot of sub methodologies within the technical analysis. It's all useful, but there is another approach. You could specialize in something, right? So if you feel that methodology, Wyckoff method, is something very synergetic with how you think about the market, or maybe even conceptually, it just gives you more assurance. It's kind of like, oh, it makes sense. What he's saying in terms of the institutional presence, how it's been shown in the chart, how he goes through the analysis, how he explains the concepts, then be with us. This is your chance to have less resistance to the knowledge and skill building, and therefore better, quicker progress, with your trading. All right, so secular long-term trend is up. Intermediate trend, which we start observing, specifically with this spring low in September, October of 22, is up. And then the short-term trend, you could say that we've just had one of the best rallies that we have had throughout this whole structure. Probably this is the second best. So I would say this is the best, this is the second best, this is the third best rally in this formation since the high in 2022, 21. And the character of this move up, which we suggested that the character of it is going to be a very speedy, a very swift advance to the upside. And how could we actually make a call like this? So please note that we're making the call around this area right here, around this support, where we're coming to the exact point where we stopped so many times before. and we have a favorable background, and we see the shortening of the thrust to the downside, suggesting that there is some demand behind it. And then the response to that was like this first initial 3 to 4 bars with the initial thrust. So just based on this initial 4 bars, we said that we're going to have a very, very rapid advance that is going to take us to the all-time high by the end of the year. What a beautiful call, and it materialized right into the end of December. And that is still suggestive to us that we're still bullish. We might have some kind of consolidation here. We're thinking that we're going through the rotation season in January, possibly even February, and we could be in some kind of consolidation for some time. In fact, I kind of forgot about this, but let me show you something. Let me show you the possible path. And I hate all of those predictions, but let me just show you how I possibly see the unfolding of the whole year. And I hope that I could find it. All right, here we go. So this is from WMD class. Ooh, did I move it? Oh yeah, somewhere here, yeah. Here it is. So here's my assumption for the whole 2024. The strength of this rally suggests that we need some kind of testing. So this is what we're thinking. Yeah, in fact, now let me just do this. I apologize. I kind of did not think that I'm going to be showing this. So let me just show you a better version. Okay, here we go. I published this on Twitter, so there's a little bit more description right here. So after this strong rally, we want to have some kind of pause. We want to have some kind of testing. This testing is done through the rotation. So we're seeing, for instance, like some rotations out of some themes, like we've seen some profit taken in the Magnificent Seven, where the money goes. It goes to other different areas. We do discuss this in different classes, specifically WMT is a great class, for that particular purpose. I'm thinking that after that, seasonally, we're gonna be going up. The strong 2023 suggests that we're gonna have still continuation to the upside. The character with which the rallies in 2023 has happened suggests continuation to the upside. The pause that we have at the previous all-time high and the way, at least for now, how we're consolidating suggests continuation. But that continuation is probably not going to be, that extreme, that strong, like it was in 2023. So I'm thinking still up year, double-digit return, but lower than in 2023, somewhere like in low teens. And I think that we are going to have some period of time where starting maybe in July, we're going to go into anticipation of the US election. And with that, we might have some kind of vulnerability here, some weakness. The price structure could come back to some of the previous levels that we've had early on, maybe in Q1, Q2. But once the US election is resolved, then we are having the seasonal rally into the end of the year. So this post-US election run up into the year end. So, it's a hilarious exercise, like who knows what's going to happen, but you could make your intelligent interpretation of what's happening right now, how you see the structure and how the structure could possibly develop just based on the events that are upcoming, possible reaction of the institutions and seasonality, of the price structure. Let's kind of see if it's gonna hold its ground. I don't know. We'll have to see. Okay, let's go somewhere else. Short term, we are definitely in the trading range, right? So this is the approach that we have to the all-time high. It's still really strong. The first initial bar has some supply in it, reverses this, the ending of the swing pretty dramatically. So you know that this diminishing demand right here suggests a reaction that's going to be a little bit more extended than this bar right here, usually into the body of the point of control bar right here. So we kind of see a natural stop right here. I like the way how today everything just went up. You kind of could sense from the intraday trading, if you did trade today, that we are in a very strong environment off the bottom. And this is the best bar so far since the point of control bar right here. It still suggests bullish behavior. And I'm thinking that we could have some kind of continuation of the testing after this rally. Everything needs to be cause and effect. Everything needs to be balanced. So you exerted a lot of energy on this, so you need to go through the testing and just to make sure that some of those excesses in buying are being sold off and they're being observed in the same kind of like mini cycle. All right, let's go somewhere else. Let's go to Bitcoin just because it's so popular. So we've been absolutely spot on everything that has happened with Bitcoin, like in this area right here. We've called this as the beginning of the major uptrend, where the character dictated that we're going to overcome this high and we're going to start, probably approaching the long-term downtrending channel. The character of this and this and this and this was suggestive that we are in the we are in the uptrend basically. And then lately this failed signal right here that we've discussed with students a lot of the times and the character that comes after that with the upsloping test is still suggestive of strength, is still suggestive of the uptrend. I mean, at the best, we said that we're going to do something like this, something similar in the overbought condition where we're going to stay. We are staying here, and it seems like a good call in the uptrending environment. But again, the strength of it is still suggestive. You need to hold this position. There is no really like a big reason to get out of this position. And we know that with acceleration, the strides change. So that could accelerate, the price movement as well. So far, overbought condition, we are consolidating. The current breakout is still healthy. So I would be still expecting some attempts to continue to the upside. Look at how supply is coming in, and then instantly the result is, favorable. The test of it is also favorable with such a low supply signature. All right, let's go somewhere else. Let's go to gold. I think gold needs to be thought as the long-term structure. And we've talked about gold for so long. I'm still in my position in gold as a long-term investment for me in my IRA account since 2019, right here. This was my point of entry. And this is the longest trade that I've had in my life. I don't really care about what's going on because I have higher targets, the targets that are above 3,000, 4,000. I mean, like I'm not gonna like even do anything here except for add opportunistically if I see that the character demands for me to act. But this is my long-term trade right now. I told you that I'm going to show some. And the way how I'm thinking about this was the all-time high. This was an accumulation, and we could go through all of those Wyckoff patterns and discuss them. Then we had a major sign of strength that brought us to another all-time high. And with that, we are developing a major backup action. Within this major backup action as the trading range, we are also observing attempt to overcome the highs as a minor sign of strength and as a minor sign of strength right here. And we probably just first consolidating here and we are consolidating right here. So I would be thinking that the price structure is all related to those two circles right now. This is what we are kind of looking at. So that's a long-term picture. But if we were to look at the short-term picture, definitely this rally right here after this decline showed an immense strength. And even though supply has come in, and we should respect that. But as I always say, emergence of supply is not the license to sell. The license to sell your position or open short positions is through the price structural change, through the behavioral change, and we don't see it yet. So supply comes in, but the price comes to the logical level of where it should stop, and then comes back into the trading range. So I'm thinking we're just testing here, and we're just going to be in some kind of trading range. And a lot of assets, I think, will be in that trading range for the duration of at least January, at least going into February. Okay, so what else? Let's just quickly look at oil. Pretty fascinating puzzle here. This is probably the most enigmatic charts for me as of now, and I like those enigmas, that we have in charts, because you need to solve it. At one point, I mean, like, we obviously saw the weakness after this lower high. Look at this verticality. There is no demand, suggesting continuation, suggesting the break of the global structure. Global structure is being broken pretty easily with the increase of the supply, so suggesting continuation. So now we know we're going to test this. We tested this. The rallies are not that aggressive, and with that, we know that we're going to go and we're going to retest this area. As we go down, selling is diminishing, shortening of the thrust. Here's our call that we are in the vicinity of the low, at least an intermediate low that should have some kind of intermediate stop in action. With that, we've produced a local change of behavior as an automatic rally. So currently, I'm thinking we are in the trading range. Now, this trading range does not excite me too much. I mean, this is not the strongest rally on diminishing demand. And then right away, look at the reversal, look at the character of it, look at how supply is increasing. So that's not what we want to see. And just recently, like this bar, okay, people asking me, okay, what do you think about this bar? Well, it looks good, but what did it really achieve? Did it overcome the previous bar? Did it close the breakdown bar? No, there's just some effort that comes in, and it's heavily, not participating aggressively to the upside. And then look at the today's bar. Again, aggression, reversal, character, and supply. So this is still weak. And that's kind of like, wow, very interesting. What is going on here? Well, we need to read the truth of the chart, as I usually say. We saw a lot of bullish activity, and we called this rally so well, but we also were thinking that we're going to have some kind of trading range right here and continuation. It's the character with which the price has failed. This in this area right here suggested that we're going to retest the support. So we had to adjust our analysis to indicate that, and our trading to execute in this way. And you have those moments when your analysis is going to become a failed signal, and you will know how, and you have to know how to deal with this, on the analytical, execution, and also mental levels. How do you reconcile that your analysis became incorrect, and how do you trade that? Because a lot of other traders who know and who kind of like follow the market with the flow, they're going to have the same issues right here. So what are they going to do? There's going to be some kind of sell-off. So failed signals are probably one of my favorite signals, to take. All right, so here is our brief, okay, maybe just to finish, the 10-year, which we like to look just because of the stock market purposes. So we've analoged these stops, we've analoged these changes of behavior, and right here was the difference. No demand, no demand, no demand, no demand, no demand, and we said that we are not going to stop here. So one of the other calls that we've heard was at the buying climax level, we're going to stop and we're going to have some kind of rally here. We did not see it here. The character just suggested steal to the downside, which happened. This was a little bit of the fluke, but I think that 2024 just to go forward, with what we could possibly see, a trading range. And we're probably in the lower part of this trading range for some time. So I think we're going to be in a more favorable yield rate situation, with possible, easing into like the end of 2024 or second part of 24, but predominantly slightly better, but still elevated. Okay, with that, we are done with our analysis. And this is what we usually would do. I would definitely be less specific during our classes. I want us to concentrate more on the actual material. Gabriela is asking, is it possible to add an analysis of ASX index? So this is Australian index, if I'm correct. And it's possible to do that, Gabriela, in the WMD Wednesday class, where Bruce and I, we look at students' submissions. So we actually looked at, different international markets on multiple occasions. We have students from Australia, New Zealand, Asia, Middle East, Europe. I mean, we've looked at so many of those international markets. So please send your chart to that particular class and we'll look at that. All right, and here's this class, and I can't say enough the words about Bruce. Bruce Fraser has been a teacher of Wyckoff methodology for a long time. He has been a money manager. He has been an analyst. He worked together with Martin Prin and Joe Toner. They still work together, and they're kind of like big friends. And Bruce brings such an immense experience and storytelling. And I always encourage people, if you want to understand the methodology, listen to how the method is being described by different people who are experts, who have this knowledge of teaching you what the method is about. It's always beneficial that way. And obviously specialized with, some coach or a teacher where, something resonates with you the most. So what do we do there? We look at the current market, like what I did right now, but in more details. We go through the stock selection, and we do, some other different things that are a lot of fun. So, quite a big community there, of traders attending this particular class. A question from Gio: will you post the chart in the sessions from January 5th on our YouTube channel, on your YouTube channel? Yes, absolutely. So I already asked our team members to do that, Gio, today, and that video is going to be on, hopefully tonight. Eric did an excellent job. Eric is the new addition to our team. He has been a student, by the way. Do you know that all of the members of our team are our students? We just don't take anyone from, the outside. Everything that we've created is from within, with our people, and I'm really, really proud of that. Okay, next question. What expectations should I have when taking the WTC1? Students definitely describe WTC1, WTC2 classes as drinking from the fire hose. And that relates to the amount of the information that I give you in those classes. Even right now, you already probably somewhere thinking like, wow, that's a lot of information even through the analysis itself that he's like throwing at me. All of those terms, all of those definitions, look at this, look at that. And it's definitely going to be like that, but it's systematic. Like we understand what are the basics that need to be taught first. What is the sequence of the material? In a lot of cases, I have students that come into us and they're like, oh, I don't need WTC1. I want to jump to WTC2. And I've done this before, and it was such a disaster. People just overestimate their level of knowledge. They do not understand necessarily the semantics that we use, that start distracting other students in the class, and we're just like losing time. So every student that came with that request, and we redirected them to WTC1 course as the first step, have emailed us, have told us that that was the best decision that they've taken, just because WTC1 is way, way beyond the information that they thought they would be given. So please keep this in mind. You're gonna feel like you came back to school. Like literally, you'll do the homeworks. I'll be asking you questions. I'll be kind of like assessing what else you need to do beyond just this class. I always communicate with students on their, progress on their development. So it's a common for me at the end of the semester, receive an email like, Roman, what do you think? I've done this, 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 and this. These are my results. What should be next? Sometimes we would jump into the coaching session and we would say like, okay, let's look at what is the most logical next step in your trader's development. And then we just choose that step and deliberately go after that. One thing that we promise, we do not promise you that by taking just one class that you're going to be profitable. But one thing that I do promise is that you will drastically change the ways of how you look and analyze the charts, even from that one class. Now imagine if you take like a series of courses, a series of classes. In a year time, your level of analysis could go up dramatically. And usual feedback from students, I mean, like about maybe like 98% of students are just basically saying that I loved it. It's just so much value. It's way beyond of what I thought it would be. It's like the best investment in my trading education. There are really kind words to me personally that students leave, in terms of my teaching ability and so on and so forth. And I really, really appreciate that. Always listening to students in terms of the feedback, what could be changed, for the classes, how do they comprehend the material, how do they absorb the material, what's the best way, to teach in the most efficient way. Because I realize that a lot of you guys have 9-to-5 jobs, a lot of you have families, there are other commitments as well. So we need to, if you come to us, we need to be efficient in the way how we teach you and how you teach yourself this material. Okay, can I expect an immediate improvement in my trading after completing the WTC1 course? If you're an intermediate advanced trader and you are used to looking through the charts and you already know a lot about how the price moves, price structures, the character, you're definitely going to accelerate really quickly. And I've seen this over and over again. And I mean, I've been teaching people this material for 12 years now. At both, Golden Gate University in San Francisco, and also with Wyckoff Analytics online. And it's definitely possible. But if you're new to Wyckoff methodology or to trading, then you definitely would not be expecting the improvement right away. You definitely will improve with each month. Absolutely. You will start seeing more and more and more. And hopefully that seeing more will translate into better execution. Although it doesn't work that way for the majority of people, but in some instances, it happens this way. And it usually takes, in our estimation, based on this 12 years of experience that I've had, about a year and a half to complete the full process where you develop yourself as a trader that could not just have the knowledge, but recognize that knowledge on the chart, recognize those patterns, and then act on them. So WTC1, WTC2 process, and then the private sessions that lead to training. And that is the path right now for us and for all of our students. We basically, when you come into our ecosystem, we are basically telling you, you define the level of your own commitment, and we suggest a program for that particular commitment. If you want to be more of an observer and just go through the material and just to collect the knowledge, you're welcome to do so. You want to do a more meaningful work where you start developing the skills, you could definitely make that step. And if you want to go all the way and meet you at the place where you have such an inspiring dreams for yourself as a trader, we could at least consider that and we could explore the opportunity to do that. I can't promise you that I could take you to the promised land. You have to do it for yourself with that commitment. But we definitely have the system where will at least explore for you whether you are capable of being there. All right, Richard D. Wyckoff. Who was he? I absolutely love Stella Asoba's presentations that Stella made for us during the Best of Wyckoff conferences. And by the way, each year we have a conference, Best of Wyckoff. Last conference was actually in San Francisco. This, summer of 2023 in July, we had the team there, we had our students there. It was a fantastic event. But back to Stella. She came to us, we asked her to come after she published a series of articles in Stocks and Commodities on Richard DeMille Wyckoff. And I would suggest that you guys go there and find those articles. I believe they're on our website as well. You also could go to our website and find the Best of Wyckoff conferences. And when was it? I think it was 2019. Yes, 2019, when she came to us, and it's free. So listen to her presentation on Richard D. Wyckoff, or read about that. So Wyckoff was everything. He had a career on the Wall Street, since he was a boy. And the culmination of his career, I think, was being an editor of the magazine of Wall Street, which he founded in 1907. That magazine no longer exists. It was closed by the relatives of his second wife after the divorce, with whom, Wyckoff obviously lost the magazine of Wall Street, and she took like over 90% of assets that he had. What that produced is that the magazine existed until 1974, and then was closed out by uh, by the heirs of Wyckoff and his second wife. But and that was the worst trade that he had in his life, I think. I usually make that joke about him, his second wife, taking him, completely out of all of his assets. And he was a pretty rich guy by those standards. I mean, like, he had a big estate property in Long Island, like I believe like 7 acres. He had his business. He had a very successful subscriptions. Like, there were like over 200,000 people subscribed at the time to his services, and you could imagine at that time, he's charging like $3 to $5, per subscription, how much money he's getting, and just like unbelievable. He was an amazing trader as well. He was practicing different time frames. In a lot of cases, he would do long-term campaigning and swing trading. Like, we read a lot of that. Well, he also did a lot of day trading and tape reading. So he was definitely an authority. What we're grateful to Wyckoff for is that he collected all of that knowledge and codified in a very kind of like foundational way. And we also are recipients of a lot of articles and books from Wyckoff himself and his associates throughout years and years, as they published not just in books, but also the ticker was created by Wyckoff himself, and he would interview all of the great traders at that time. So you could find references to this, and obviously the magazine of Wall Street. A very common question to me from students: should I be reading Wyckoff books? If you're a beginner, I want you to concentrate on the sequence of books. I want you to read first Hank's book, and Hank was my mentor at Golden Gate University on Wyckoff Method, and just everything teaching. So I'm the product of that, academia type of education and teaching and practices of how I should be teaching you guys. So Hank's book is called The Three The Three Skills of Top Trading. So he discusses Wyckoff methodology, and those are the basics. Then Bruce Frazier's blogs on stockcharts.com. And then after that, David Wise's book, trades about to happen. So this is going to be more for intermediate advanced traders. And then all of our videos on YouTube. So, and that's the sequence, that's the exact sequence that I want you to go about. You could watch the videos at any time, but in terms of the books and the readings, these are the three sources that I want to point your attention to. Okay, what else? His course, came out in the early 1930s, and again, it's kind of ironic that he divorced his second wife, he took everything from him, but that pushed him to creating, the course, and he passed away in 1934 in Sacramento, California. And it just, he didn't have a long life by our standards. I think he was 61 when he died. And but this course came out before his passing, and we are grateful that it happened that way, in terms of how the material was given to us. Again, the question from students, should I be reading this? So I would say this: do the WTC1 course first. Do all of the readings that I've just suggested at the same time concurrently, or after that, or before that. And only then, when you graduate to WTC2 level, start reading this course, because it's definitely outdated, although contextually, conceptually, it's all there. And you need to read it, but you need to read it at the specific time. And that's just my only suggestion that I usually have. So kind of like, don't read War and Peace right away, read something smaller first, that type of suggestion. Okay, let's go to other questions. Do you use Wyckoff Method in your trading? I only use Wyckoff Method in my trading. If I bring something to the methodology, it could be from other methods where like I'm maybe like picking up some concept and I could translate that into the Wyckoff methodology. Sometimes, occasionally that happens, but I predominantly use Wyckoff Method. And usually my advice to the advanced students, so if you're advanced 1 or 2 level, we have 2 levels how we define the advanced student. I usually say no to books, no to YouTube videos. So this becomes a distraction at this level. I mean, like at the really high level where you already in the system of making money consistently, it's just a distraction. The only thing that I want you to look at where the truth is. Go to the source, go to the truth. What is that, guys? Can you tell me? What is the truth about, trading or your analysis? It's only one thing. It's a chart. So I want advanced traders to spend majority of that time not mindlessly, unconsciously watching another video on YouTube or scrolling through TikTok and looking at some analysis by some random trader. What I want you to do is to concentrate on the charts, and I want you to develop your skills consciously. And that's where we are. So you kind of could sense like, I'm pretty serious about this education. So if you're gonna come into us, you gotta be serious about your education as well. Can you show your latest trades? Yeah, I'm gonna show you, 2 different things that has happened. So this is probably like, I wanna show you different trades, right? So I've shown you the gold trade since 2019. So this is more of the long-term campaign type of trade. This trade in Netflix in 2023, 22, 23 is just showing some, swing trading. So this is a long-term swing trade. A short-term swing trade would look something maybe like this, where we are getting into the position, getting out on the change of behavior. So this would be a short-term swing trade. And then obviously intraday would look something like this. So this is pretty fresh. This is from today, from January 8th, 2024. This is just what I've been trading today. So NASDAQ was and S&P were trending. Why am I trading NASDAQ today and not S&P? I started actually trading with S&P. My first trade was profitable, but was not efficient. So seeing that NASDAQ was stronger than S&P, than ES, I switched to NASDAQ and then look at the trades that were produced. A little bit of the mistake right here, just getting out of this. This should just be staying on for the whole day because it's a trending day. These are usually the trade profiles that I like on the trending day. And then I kind of got greedy a little bit at the end, went short, was thinking like, could we have some kind of rebound into the close of the session? This is a Pacific time. And it just was so strong, it just didn't get me that chance. So 2 wins, 1 loss, but the loss is really limited and the wins are pretty substantial. So that was a really good day today. And then Tesla, until we actually had this bar, a point of control that was confirmed later on, we couldn't get anything going today in Tesla. It was in the trading range, while other markets were kind of like in the trending environment, and that's what was so frustrating for Tesla intraday traders today. But once that trend and once that point of control was established, then you stay in the trend. So, and that was the trade today. Now I'm still making mistakes, and this is very common for all of us to make some mistakes. The key is just not to go to the egoic place and just to have the capacity, mental capacity, to analyze, was this a good point of entry? How am I driven to get out of here if I'm still thinking that the bias is going to be to the upside? Could I be more efficient with this exit right here? Were these two behaviors correct? And I'm seeing that they probably were not correct. And I analyzed those today with our intraday trainees. Or like, for instance, this stream, was that acceptable? Was this good enough? But this is just an example of kind of a really good trade today, and really good day today for trading, because everything is trending, so you catching the trends better. Usually during the consolidations, our win-loss ratio is going to go down, and it's a completely different way of how you would trade consolidations. But these are the different 3 examples that I've shown to you today of what I personally do and what, where we go with all of the training and so on and so forth. It's all about consistency, it's all about accuracy, it's all about efficiency, it's all about sizing, it's all about system that produces higher level execution. It's all about how your mind works in this environment, where you create emotional narratives of what environment that is. Are you trading in the stressful environment? Are you trading in a more comfortable environment? How does that translate into your execution? There are so many things to consider. All right, let's talk about the heuristic narrative of the composite operator. So who is that man? And why not use the words of R.D. Wyckoff himself that he published in the magazine of Wall Street? This is his article, The Composite Man. And I'm not sure about the year that it was published, but let's look at this paragraph right here. Who is the composite man, and where can he be found? He consists of some 2 million personalities scattered around the face of Earth. So this is probably the number of traders at that time when this article was published, the perceived number. Some of his component parts are richer, more powerful than others. So those are, those big institutional investors, the CEOs. Some are noted for their foresight, intuition, shrewdness, and conservatism. Those could be analysts. Those could be some kind of money managers. And then some for the dashing, daring, reckless quality of their moves, speculators. These millions of personalities form one omniscient who sways the market, crushing those who don't know and will not learn how to benefit by him, and crowning with profits and income for those who do. So he is saying that the composite man is not just one personality. It's not just in the current environment, it's not just Jesse Livermore. It's not just Warren Buffett. Even those figures were prominent at their own timelines, and they had their own ways of how they influenced the price structure. But in the current environment, when we talk about like large caps of like Apple being at the 3 trillion capitalization, one single company, no matter how much funding they have, cannot influence the price structure to the degree that Jesse Livermore was capable of doing this in the early of last century. And just legislatively not possible, size not possible. You only could do this with, low liquidity type of stocks, in which we see a lot, like, some run-ups that last for a little bit and then they're being sold into the strength. But when we combine all of the institutions that have the same type of outlook on Apple, when we also add the analysts that talk favorably about Apple, when we add the institutional followers and professional speculators trading in the same direction of the price cycle of the stock, then we get this heuristic figure of the composite man. And we say that everybody who's on the correct side of the price cycle is that composite man. Even a good advice on the TV from an analyst could put that analyst in that pool of people who are composite men, as a heuristic. Obviously, composite men back into the early of last century was perceived in a different way, right? So Wyckoff had access to many people of his era that were like big figures, big speculators like James Keen, Jesse Livermore, and others. And he observed how they would conduct a campaign where the goal for those campaigns was to take a meaningful amount of supply and assessing the current market condition to determine whether this supply could be uh, distributed at a much, much higher price level. And those were the tasks of those speculators when the owners of the company would hire them to manipulate the price of the stock to the higher levels to sell more stocks to the public. Jesse has done a lot of those campaigns. He's done it, on behalf of different owners, and also he's done it by himself. And all of those, rules that were used, or not all of them, but a lot of those rules were codified into the courses by Wyckoff as he was showing the public what the actual, stock operators and market operators were doing. And obviously, there is a lot to that. I mean, like those operators, it's not just the size, but it's their deep understanding of the market. They still needed to understand favorable conditions to do all of that. And they would operate obviously with large amounts of money, for that period of time. All right, we have a lot of tools that we've developed for our students that are educational tools, that are communal tools. One of them is the bias game. Bias game is probably one of my favorite educational tools that we have. This is an opportunity for you to study on your own, but under the guidance of our feedback and advice. Bias game is something that is being published on a weekly basis. Each week you receive the new chart to decipher whether you think that this is an accumulation or a distribution. You could vote on Twitter. Usually on Twitter we have the freshest charts. You could also go to our website where currently we have over 200 bias games ready for your studies. So it's a meaningful tool, and I want you to go to our website and start exploring it. I want you to become a part of the community that solves, those bias games on Twitter and in our classes. Our WTC2 students obviously spend so much time on this bias games because this is a skill development exercise for us. So check it out. All right, really quickly, some other questions. What are the major goals while using the Wyckoff method? We need to make the correct observations. In a lot of cases that I see is student just can't make correct observations. Let me make a point about this. Why is it so difficult to make those observations? There are quite a lot of data points that you need to observe, and you need to put them together in some kind of like logical understanding of what's going on here with this particular chart. And because of such a huge number of data points and our limited ability to comprehend so many data points, we can't really see everything. And whenever we see something, our minds usually goes to some screaming parts of the chart. Maybe there is a volume spike, maybe there is a gap, maybe there is an extension of the spread, and so on and so forth. So our minds give more meaning to those more subjective events. So we are learning in our classes how to read the chart correctly, how to make the correct observations. After we made observations, we need to make a correct deduction about those observations. And this is where the strength of the methodology helps us to create a solid logic about what is happening with the chart. So with those deductions, we judge the strength of the dominant force, buying or selling. And from there, we made assumptions with some kind of degree of the probabilities that we assign to that specific setup, whether we're going to go long, we're going to go short, whether this move is going to extend or whether it's going to be more contracted. And obviously, we want to trade after we observed and deduced of what's happening with the institutional participants. We want to trade alongside the smart money, and we want to make money with them, not against them. Where do we start our Wyckoff analysis? Price cycle model as kind of like a high level concept. Behavioral market analysis as the understanding of the behaviors of institutions. Change of behavior and change of character and price structure are very important concepts there, how this, everything changes. Price structural analysis of accumulation and the distribution. Trend analysis, then into the leaves of the volume spread analysis, VSA and swing analysis. And then a very important addition that we've made in the last 5 years, sequential bias analysis. This is a step-by-step analysis of the trading range. I will teach you how to analyze trading range and how to come up with the definition of the bias of the trading range, because we want our edge, which is what? Being in the trend, right? Taking the money consistently from the trend movements, either over swing or extended swing or over bigger trend. So we want to understand the bias as the price is still in the trading range. And as we develop the trading range, I want you to see the way of how the bias changes through the trading range. And obviously we'll talk about the tactics of where do we come in, why do we size in a specific way, what are the minimum, maximum targets, and so on and so forth. And then the last theme is the comparative relative analysis. All right, let's go into the price cycle. This is the most simplistic depiction of the price cycle. You have the area of the accumulation, and this area of the accumulation is, in very simplistic terms, is the exchange of shares between the weak hands and the strong hands. Usually we would be thinking that the strong hands will be institutional hands, and majority of the time it's right. But also it's wrong, because some institutions could be on the wrong side of the trade. So when we talk about institutions, I think it was a wrongful perception by the methodology that only institutions are right. I would say that strong hands versus weak hands is a much better definition for the exchange of shares in the accumulation and the distribution area. We usually will be looking for some price structural elements and some character elements during the accumulation area. We want to observe the stop in action. We want to observe the change of behavior. We want to the confirmation of the change of character in the price structure. We want to see the inability of the price to continue down and start to see some elements of the accumulation. We want to identify the emergence of the new trend and confirmation of that, and then continuation of that into the uptrend. As we go through the uptrend, it's also extremely important for us to develop the skills as to how to follow the trend. In a lot of cases, the concentration is always on the point of entry. That's the most important thing for us to know. Not necessarily. Once you enter, you need to understand how to move the stop loss in the most efficient way so that it wouldn't get you out of the position prematurely, and it would keep you into the position into the conditions of change and into the actual change that will start happen in the earlier phase A and B of the distribution. And that's a skill, again, that you need to develop. Knowledge is not going to be enough. I could tell you what to look for, but if you can't develop that skill of recognition and executing that particular setup right here, then you're going to fail. As we go through the price cycle, the whole idea is that there is an accumulation that is being followed by the uptrend. Then there is a distribution that is being followed by a downtrend. Obviously, this is the most simplistic way of thinking about this, but a more complex visualization of the same idea is going to be in something like this, where we're going to have ups and downs, where the volume is going to be spiky here and there. And we just need to think in concepts here. So how does the trading range develops? Well, first of all, we are observing in the non-trending environment specific changes, right? So where we first stop the trend, then we prepare to take off, and then we go with the new uptrend. And we go through what we call in Wyckoff methodology through different phases of a trading range. And different phase has different intention. For instance, phase A intention is all about stop in action. Phase B intention is all about the change of sentiment and the exhaustion by both sides, and this war between supply and demand. Phase C is the final test of the supply and the accumulation at the level of the support. And phase D is the emergence of the new trend, a markup within the trading range. Same for the distribution. They're all going to have the same concepts: stop in action, exhaustion of both supply and demand, building up the cores for the subsequent move to the downside, and then phase C, final test of the demand, phase D, emergence of the new trend. And uptrends and downtrends are going to be labeled differently. We are not going to have phases. We're going to have just characteristics for those trends. And of course, in real life, it's even more complicated, and it's going to look something like this. So on the way up to, let's say, a distribution of the accumulation low, we might have some swings to the upside that are going to be followed by some areas of pausing, which we would call a stepping stone reaccumulation trading ranges. And our goal is to understand first that this type of setups are very favorable to us, especially after the trend is established, and we would treat those reaccumulations as the testing consolidating zones. We would be looking for the points of entry within those consolidations, and we would be still thinking in terms of the phase analysis of how the price is going to go through some profit taken at the beginning that's going to increase the supply, that's going to produce the change of behavior, that's going to produce the understanding that we're in the trading range environment, and then swings up and down as we go through this environment, coming to the timing of it, of where most favorably we should be entering our new positions or the add-ons. Here's an example of the secular causality and secular effect. And this is Apple monthly chart. And you could see that throughout 1990s and to early 2000s, we were in this immense trading range. It's a huge trading range. When we take the P&F count, when we took this count of this whole area, and it actually goes a little bit further to the left, we got the target that got us just to this level right here. So one might say this is too big. I mean, like this lasts for years and years and years. Go to the stocks like Microsoft, Oracle, Nvidia, those type of big stocks, and look at their accumulation ranges that lasted since the bust of 2000 into this new cycle, and you will see those type of multi-year huge formations. And we still need to understand that the concepts are going to be the same on different time frames. Here we have the monthly chart, but we also see that the secular causality and secular effect would be somewhat similar to the cyclical causality, where we have a smaller trading range, where there is a markup, where there's a smaller distribution and there is a markdown. And then as we go even more into lower time frame, we will find the price cycle there as well. Okay. Check out on our website the weekly newsletter. This is a very simple way to be always connected to us on the weekly basis. We send out our weekly newsletter on Sundays. We tell you what we think about the market, what the latest publications, whether those are video or blog publications, and any type of news that come from our community. Our YouTube channel, the Wyckoff Trading Method, is the place to be as well, and Twitter, obviously, with all of the announcements that we have there. Next question, and this is a big one. Do Wyckoff schematics predict the future path of the price? No. And that's such a misconception by so many people. And it's kind of interesting, as I personally went through quite a lot of cycles of where we have some market events and then people come to us as an outcome of that event. So in the, when was it? 2021, I believe, we had this big influx of the crypto traders that were using our Wyckoff schematics that I've created, for stock charts. And those are extremely popular schematics. I'll show you those. They were using them for the Bitcoin structure, and it was perfectly matched. So there was this erroneous idea that the price should follow schematics exactly to that last swing, to that last bar, and that's just not true. The Wyckoff schematics were not developed by Wyckoff himself, by the way. Wyckoff was not the one who developed those schematics. It came after him. What I've done is just I redrew the schematics, according to my personal interpretation. So we use schematics as a guideline as how price might potentially develop under the similar market conditions. But when we look, and we're going to look at the schematics in the next class, and the accumulation and distribution schematics, and I'm going to give you the homework just based on those schematics. You're going to start labeling the price structures, and you're going to start going through the phase analysis, Wyckoff events analysis, and slightly, bias analysis. But we only use schematics for the conceptual understanding of what might happen. I will show you many variations on those schematics. By the way, at the end of February, beginning of March, I'm going to be conducting WTC3 class. So that class is going to be all about the price structure. And it's going to be a lot of work that I'm going to devote into analogs, and I'm going to connect them together through the sequential bias analysis. And we're also going to look at the playbook tactics as to how we execute those strategies. And it's going to be extremely advanced. So the prerequisite for this would be at least WTC1 class. I don't want people who don't understand those concepts to come and just waste their time and money on this. Behavioral market analysis, what is it? Studies of market participants' behaviors in the context of the price structure. So we want to look at the events on the chart and say institutions have done this at this spot, and their next step is going to be this out of that. So this is a more point-driven chart of the price cycle. So what are the points that we're trying to communicate here? At the stopping action of the selling climax, we usually have the extreme point of fear and capitulation by weak hands. So this difference between strong hands and the weak hands, I think, is the most essential one. The strong hands is any trader or investor who's trading in the harmony of the price cycle. The weak hands are people and traders who are in disharmony with the price cycle. So when we are wrong, we are in disharmony, we are weak hands. When we are right, we're strong hands. So the weak hands at the stopping action, the selling climax, will be capitulating, whereas the strong hands would start intelligently accumulating the position at this point. And then at this point where the emergence of the uptrend starts in accumulation, we will see that retail people with all of the ups and downs of the trading range would be mentally exhausted to participate in the emergence of the uptrend. They will be inactive, while some institutional trend and momentum adapters will be heavily participating and establishing their initial positions. In the area of the distribution into the buying climax, we're going to see the first signs of the intelligent distribution by strong hands, and we're going to see the extreme point of excitement by weak hands. Actually, there is one point in the price structure where the weak hands are going to be enjoying the profitability, and this definition here of the weak hands would not be irrelevant. It's right here. It's in the second part of the advance of the whole, secular cyclical uptrend, where we see less of the supply and the price moves in a more speculative character type of way. So with that, it's much easier for the weak hands to be profitable. And that's what lures them back. It's this piece right here that is basically keeps them returning back and experiencing all of the pain throughout the rest parts of the price cycle. But in this specific area, they're usually correct. Kind of ironic and very sad at the same time. All right, what would they do? What would the weak hands do during the, let's say, a trading range here? They would be thinking continuation to the upside, and therefore they would be buyers at the level of the support or somewhere higher. With that, when the price breaks down, they need to close. That creates more orders to sell, and that becomes, the market that just falls under its own weight. Conceptually, in the idealized conditions, the strong institutional hands will behave this way. As the price falls down, they are buying in the oversold, undervalued conditions, and they are starting to accumulate their position. Then they're still buying on the way up, and other institutions are joining the composite man, the composite operator, as they start recognizing that there is an emergence of the new uptrend. And then they become inactive in the second part of the uptrend. Whereas the completely different sequence would be for the weak institutional and retail hands. they would be selling on the way down to avoid the emotional pain of the loss. They would be selling as the price tries to rally in the trading range, and that would exhaust them emotionally. And with this loss and this emotional exhaustion, they would become inactive. And with that, look at how different and completely opposite to the strong hands the weak hands behavior is. And once they finally see that this is an uptrend, this is where they will be aggressively buying on the way up, and they will make some money. And I'm sure all of us have been in those situations where we were weak hands, where we did recognize a more momentum type of market. And in some instances, people even recognize it, but they can't trade it. They come into the position, they either too early, too late, they can't hold on to the position. And in a lot of cases, even today, with the training people, it's a trending day. And then at the spot like this, I'm seeing how they are failing to recognize the trending day, and they can't stay in this trend. So a lot of mistakes here, but this is the moment of the profitability for weekends. And as the institutions and the composite men are selling during the distributional consolidation and then capitulation on the way down, what are the weekends are doing? They are actually buying as the price falls, and they are holding in this area right here. Okay, let's look at the examples. So we've talked about Apple. This is a very long-term chart of Apple. And again, strong hands. How would we see this sequence of buying, and then being inactive, selling and selling? So obviously we don't have a distribution here on the secular level, but let's look at the secular buying. So we're seeing, observing that the volume signature increases. Would the retail people do this? Are they capable of doing this? I doubt so. Just because you need to have so much money, and retail people don't have as much money as institutions. It's a fact. You can't dispute that. And we're therefore, when the volume increases in a meaningful way, in the institutional way, we want to look at the result of it. And the result is showing buying on the way up as the price extends and advances higher. As the price goes down, obviously, what has happened in the 2000 is the market collapse, the bust of the technology bust. And with that, Apple, even as a leader, was sold off, but sold off later on, and we'll study the way how Apple was sold off in 2000. But then look what happens with selling, diminishing selling, and then again there is a wave of institutional buying, now even more. So they are buying on the way up. They were buying as the price was going down within the trading range, and then the price leaves the trading range, and they're still buying on the way up. Also, a big misconception that accumulations only happen during the consolidations. First of all, accumulations happens on the way down. And secondly, accumulations could be happening on the way up as well. Did you guys know that? So with that, I mean, like, we could have so many different variations on the price structure. And this is something, again, that we will be discussing in the WTC3 class. Let's follow the volume signature. Let's follow the correct observations about the institutional behavior next. So we're still seeing a relatively high institutional buying rate here, akin to what we've had in the late 90s. But at the same time, and we know that they're still buying, but at the same time, it's not as much as before. So therefore, we see a lesser of the activity in terms of how much was being bought by those institutions. And they, like Warren Buffett, like, they buy, and some of them hold on to a company like Apple for a long time. What's the reason not to? I mean, like, this is the company that is consistently innovative. They are with the established, huge, $1 billion revenue each quarter, in billions, and for capitalization. So they have to be in those type of stocks. So once they bought, a lot of them are going to be holding on to that supply.
not putting it back into the marketplace, and that's what's going to sustain the uptrend. And again, this is something that we will be studying. Look at the different time frame. So now going from monthly to the weekly, everywhere you're going to see the same type of concepts where institutions are buying on the way down, on the way up, on the way down, on the way up, with all of this volume signature right here. And then from the trading range, accumulation trading range, we're going to produce a sign of strength, a backup action as a trading range, as a stepping stone, reaccumulation, continuation to the upside. Here is our distribution, and here is that market push to the downside that takes Apple on earnings with the massive gap down. And we have that price cycle of accumulation, distribution, markup, and markdown. You go to the lower time frame, this is a 2-hour time frame, and you still have the same, you see the same principles on the chart. As the price goes down, we see buying by institutions. That buying stops the price from going more down and creates, the preconditions for change. As the change happens, we see how some other institutions are starting to buy on the way up. That gives us a confirmation that now we have produced a change of behavior, and we have produced the change of character in the price structure. Different, reaccumulations and so on and so forth. And then they start selling into the strength. And that's what institutions usually do. And we'll talk in the second class about the reasons of why they actually don't wait like a retail trader for a change of behavior. And they have to sell into the strength, into the excitement by weekends. Very quick answer to that is because of their size. They can't really sell a lot as the price already goes down. If they would just accelerate the price going down even more, putting them at the disadvantage as they sell at the lower and lower prices. So in a lot of cases, you're going to see selling into the strength. Like here as well, into the gap, and they sell. What's the immediate result of that selling? To the downside. So now we know that we potentially could have that change of behavior. Well, let's talk about the market participants. Who are they? And how would we differentiate between them? And what are the pluses and minuses to be in one category or another? Let's start with the institutional contrarian investor. And here, Warren Buffett is actually like the greatest example of it. PIMCO or BlackRock, those big companies in those two markets, different markets, where they could have so much influence on the price structure as they establish their positions. And all of them, we would say, act as the composite operator. They usually base their trades on the value methodology, where they are seeking undervalue or overvalued conditions for them to start initiating their trades. Their size is usually huge, and that's why when they operate, they are extremely visible on the chart, and they are extremely influential as the way of how the price structure develops. Their time horizon is usually on a very long-term secular cyclical time frame, and that allows them not to be swayed by any of the daily, especially intraday type of activity. And they develop their models based on the business cycle that lasts usually from 2 to 4 to 8 years in some cases. And it's very beneficial to study institutional behavior with experts like Bruce Frazier, Joe Turner, Martin Preen, where they look at those time frames and where they understand how institutional people are committing to their positions and based on what conditions. What are they looking for? They're looking for the long-term value. They're looking for the short-term liquidity. Short-term liquidity allows them to come into the position with a lot of size. Long-term value suggests that there is a meaningful uptrend in the direction of their analysis, and they could stay in that position for a long time. To do that, they need to develop the contrarian view, the contrarian sentiment about where the market is right now. And this is a skill, this is a mental skill that comes from sometimes research, technical skill, adapting the correct beliefs about the market that would tell you that if the majority of the people usually incorrect, you have to stand on your own. You have to be by yourself. You have to buy at the point where majority of the traders have not changed their sentiment. And that's a very, very hard thing to do. There are limitations. They're too big, so they cannot go in and out really quickly. They orient their trading around the low turnover. This is, especially for the money managers, is a huge requirement from the clients. And they also look at the tax implications of their trading, and they prefer to stay on the longer time frame, even though in the US it's less relevant now as it was before, let's say like 10 years ago, 20 years ago. But still, the money managers operate under those assumptions of low turnover and tax implications. Their edge is the time horizon. Just because they're on the secular cyclical time horizon, they have more time not to react to how the price behaves. They have more time to wait for those secular cyclical once in a generation type of opportunities, or once in a year type of opportunity, or twice or three times in a year opportunity where they could establish the position, they could add to the position, and so on and so forth. They orient themselves towards the long-term trends, which is an edge on its own. So they could rely on the fundamental and macroeconomic analysis as to how those trends develop. And they obviously have a very, very deep knowledge of the market and how to execute. They are visible on the chart through the extreme volume signature that retail people cannot create. They are visible at the points of the liquidity with their size. They're visible in the absolute and relative trends as they participate in those, and they're visible in the long-term volume signature. Next type of market participant, institutional trend follower or institutional momentum follower. So these are the money managers, whether they could be a hedge fund, mutual fund, pension fund, insurance companies that are mostly oriented on growth, but could have some value methodologies built into their system as well. They are extremely big in their size, and their time horizon is usually cyclical. So they would look at the lows, the highs, the opportunities to participate in the price cycle that would last as a position, from a year into the, the whole a price cycle of, let's say, 2, 4, 5, 7, 8 years. They look at the emergence of the trend. That's their edge. And a lot of their system built just on that. Show me something of a different behavior, then I'm going to jump into that. They usually look at the breaks of the trend as the change of behavior, and this is going to be like one of their points. This actually should not be here. Emergence of the trend. Long-term value. They are looking for that as well as the institutional contrarian investors, and short-term liquidity. Still, because of their size, they need that liquidity from weekends in order for them to have a meaningful position established. There are limitations because they are money managers, usually performance matrix driven business that is oriented towards the assets under management. So that produces specific behaviors that we could actually exploit against them. As we know that, for instance, they will be more active around the quarter ends or the beginnings of the quarters. We could use that knowledge. We could also use the price structural spots where for the majority of the time they will be present. So usually that happens at the areas of the support, resistance in the deeply oversold, deeply overbought conditions. And those are highly visible to us. They are still concerned about the low turnover and the tax implications. This is still in line with just being institutional. Their edge is the time horizon because it's more extended than for the retail traders, and they rely on the long-term trends and their deep knowledge. They are visible on the chart through the absolute and relative trends, through the long-term volume, and through the momentum buying and selling. So this is where momentum exploration of the momentum is useful to us to identify this specific institutional breed. They're usually pension funds, insurance companies, investment banks, mutual funds, hedge funds, registered investment advisors. Professional traders. They are momentum and mean reversion traders. They are medium to small size. They are on the daily swing and intraday timeframes. They're looking for the short-term overbought, oversold conditions, and they're looking for the presence of the momentum. Their limitations that they're producing too many trades, therefore high commission. And even though this is less of an issue lately, but you look at some futures traders and like the commissions are still pretty high there. Short-term taxation is there a limitation as well, as you have to pay more. And then they're definitely lower size, so they can't really influence the price structure unless there is a herd of them doing the same thing. Their edge is in their quickness, so they could get in and get out of the position and be much freer going home without positions at all, rather than the institutional investors and traders are really going to sweat it out throughout many overnight sessions. They are visible on the charts with the momentum buying and selling, short-term volume, short-term liquidity, and short-term swings. They're usually proprietary traders, retail traders, registered investment advisors. And then retail trader, majority of them are momentum type of traders with the small size, usually with the daily or intraday time horizon, breakout strategies. That's what usually is being looked at. Some points of excitement that attract people kind of almost like unconsciously to those type of events. And their limitations is that they're going to be heavily sentiment driven from the environment, external environment. They will have lower knowledge compared to other groups of market participants and lower skill. They are still quick and they could create different rules, and that's the edge that the retail traders could possibly have. They are mostly not visible on the chart. In some instances, you could see them, but it's definitely not necessarily as visible as the institutional participation on the chart. And it's interesting how weak and strong hands interact throughout the price cycle. So as I stated before, on the way down, excuse me for a second. On the way down in the downtrend, when we see that the weak hands capitulate and they sell behind that emotional idea of I can't stand the pain that I'm getting from this position, so they will be selling. As value buyers, contrarian people, traders, investors will be buying, as this is an undervalue and it's also a lot of short-term liquidity that selling by weekends produces. And then we see that the trend followers do not have a shot here until the emergence of the new trend, until they see all of the elements of their system telling them that right now the trend is emerging and it's going to be sustainable. So this is where they start buying. Value buying is still there, and weak hands become inactive. As the price goes up, and as the price leaves the trading rate and extends above it, what do we see? The weak hand starts getting excited short term and that start buying. That increases the liquidity. The value seeing this liquidity starts to sell. And in some instances, we still see the trend followers that are buying. So with that, we're seeing in the first parts of the reaccumulation, usually a lot of activity, a lot of exchange of shares between certain parts of the institutions, maybe like some profit taken from value, some buying from trend followers, and definitely buying from weak hands into the selling of the strong hands. And through the whole price cycle, we kind of go through these areas where emotionally people will exhibit the same behaviors. And it's very sad that we are this way, but it's very understandable when you look into the idea of why we do that. As species, we have fear to protect us. When we lose money, fear creeps in into us, and it kind of rules our behavior. Trading is extremely counterintuitive. You have to be brave when everyone is um, weak, right? When everyone is fearful, and you have to be fearful when everyone is excited. That counterintuitive sentiment and trading is very difficult to develop because, again, as I said, it goes against the thousands and thousands of years of conditioning that we have as species to protect ourselves from anything that could hurt us. So losing money, we interpret as a pain, as a hurt, and therefore our behaviors are going to be not in line with the market. That's why it's such a difficult craft. So once you align yourself by understanding what you're seeing on the chart and how institutions are actually contrarian in their buying and selling, and you start following the smart money, that's when you will start making money consistently and increasingly. All right, couple of last slides, and then let's go into the questions. Main questions to address. Who are the price market participants? How could we identify them on the chart? What would show us their hand? And I showed you the concepts and I showed you some examples. Here is another example. This is Apple daily chart in 2011. It's been in the established uptrend for some time, so we're looking at the areas of the reaccumulation, going into the distribution, and so on and so forth. So how do we see institutional participation? Look at the volume signature and look at the lowest volume signature. Then look at the spikes that are above that volume signature. And that is the representation of the institutional presence. Any significant increase in the volume signature is basically telling you that institutions are present there. When you look at the price and what has happened at those points of intense institutional presence, what happens? Every time the price comes, it reacts, it reacts, it reacts, it reacts, and then it reacts in a meaningful way. Not only that, it reacts in a meaningful way because behind that move, we still see additional institutional buying as the price goes through the resistance. So that is most definitely bullish. Then we see, again, a bell curve that suggests that institutions were buying in this area. So they bought here and they bought here. Why are they aggressively buying? Well, because they're seeing that the prices are going to advance. As the price starts to advance, we have another followers, institutional followers that are buying the value in the FOMO type of trade, where they are fearful of missing out on the opportunity to be in the Apple as it just drives the price, so quickly up. They need that performance, so they're chasing it and they are getting back or getting into that new position. Into that strength by weaker institutional hands or retail hands, the contrarian investors will start selling. And we see the change of behavior in this area. And that's what produced the initial stop in action, the initial change of behavior. That was the most meaningful reaction at that time. And that prepared the next move to stop with the shortening of the thrust and the reemergence of that supply. As this supply reemerges, obviously, we are seeing some institutions leaving this position as they recognize the emergence of the downtrend in this case, and they just go away. And the public always gonna be later on. Like we're gonna have general capitulation where everyone capitulates later on in the structure. The same way here, kind of like going into this moves up. We are seeing how the public starts to participate, more institutions are participating in this, and then all of that is obviously prone to a failure, that late participation. All right, well, that's it for today. I want to remind those of you who already signed up for the class that your first homework assignment is to go to our website, log in into your student profile, and find the article by Jim Forte, which is called Anatomy of the Trade. Please read that. We will have like a small discussion and references to this article. By the way, I didn't mention this, but you know, I took classes with Jim back in mid 90s, and he wrote this article for MTA. MTA was Market Technician Association at the time, which is currently a CMT, Certified Market Technicians, and this was a level 3 assignment that he needed to do. Unfortunately, Jim passed away just recently, not just recently, but in the recent years. And it's just such a big loss for us as a local community here in Bay Area, and also just Wyckoff community in general. So even if you're not taking this class and you still want to continue your Wyckoff education, read that article. It's on our website. All right, and with that, I want to ask you if you have any questions. I mean, we definitely will jump into more material next time. What are we going to be discussing throughout the semester? We're going to be concentrating on the market structural analysis. There's going to be homeworks right away in the second class that I'm going to give you um, for labeling purposes. I need you to understand how the sequence of Wyckoff events and Wyckoff phases unfolds in the trading range. That's going to be our first studies, and we're going to spend about 4 to 5 sessions on this. Then we're going to go into the studies of the supply and demand and how it influences the price. And we'll do the VSA, we'll do swing by swing, we'll do some historical analogs analysis, and I'm going to show you the exercise that we're going to spend probably 5 to 6 sessions on. This is going to be instrumental systematic exercise where you're going to study how to read the chart. And usually after this exercise, people have a lot of aha moments. Aha, this is how I should analyze this. Aha, this is the way how I should see the market. Aha, this is how to trade those type of structures. So an extremely important exercise. Usually after 2.5, 3 months, students in this course give us the feedback that I see market in a different way now. I see structures everywhere. And this is obviously a very favorable, way for us to approach this material as we're going to be building the skill during this exercise as well. Then we're going to talk for a couple of sessions about relative and comparative analysis, the filtering and scanning of how we actually find appropriate candidates. I'm going to give you some of the proprietary things that I've developed for myself and my institutional clients. Also, we'll talk about the basics of the relative and comparative analysis. Even though a lot of you know that material, I want to make sure that you know it from our perspective. And then the rest of the session is going to be devoted to trade management. We'll talk about points of entry, stop loss movement, add-ons, streams, exits, and so on and so forth. And also the last session, as usual, is going to be devoted to your questions. So again, let's see what kind of questions you have at this point, guys. That's number one. And secondly, if this session and the results of our training and trading resonates with you, then I would say that you're at the right class. You're at the right in the right community. So most definitely, I would be expecting that you would be signing up. Again, don't forget that you could. Oh, this is a wrong price here. So we are at the 3 payments right now. I think it's 332 some cents. So sign up, let's start working together. Let's start going through the material, and let's start going through the homeworks and through the charts, and let's build up that knowledge base about Wyckoff, how we observe, deduce, and how we interpret that data and put that into our trading execution, just with an idea that you're gonna go even deeper and gonna transition into the skill building with WTC2 class, with building the process, and then going towards very, very deep, super intense and involving training exercises. Okay, let's see what kind of questions we have. Gabrielle is asking, is there a point where we alter our actions? For instance, holding the buying and selling of individual names due to the current behavior of the current index macroeconomics. We alter our actions due to current behavior of the relevant index macroeconomics. Gabriela, I would say that we constantly do this, right? So, for instance, we talk a lot in the WMD Wednesday class together with Bruce about the Fed actions. Fed is the ultimate CO. It's the CO of the COs. Fed defines the liquidity of the system, and liquidity defines how much money could go into the stock market. And with that, how much of the advancement we might potentially have. So with that, it's an essential studies that we do. And we definitely would alter our trading actions once we see the changes in price action based on how the Fed is acting, in the marketplace. John D is asking, in session number 15, would you or could you show hypothetically take a 50,000 account and show how to scale in with proper sizing? John, you mean like to show some trades or some unfolding trades or simulation, or do you mean like a playbook on the sizing like at different spots? If that's the later, then we'll definitely do this in WTC3. This is the more appropriate place for it. So again, I'm just like gonna show you the playbook, literally, like all of the entries through the price cycle, with the idea of the targets, with the the concepts of why those targets are appropriate, what we should do, and with the examples of how it should be done. And not only that, I'm going to show it to you on the different variations of the accumulations and the distributions. Shivam is asking, what is the extent depth of the post-trade analysis backtesting that will be discussed in WTC1? We are not going to discuss the post-trade analysis, which is a more advanced skill. We are definitely discussing post-trade analysis in WTC2, in the trusted process special, in the process group that we have. By the way, process group is the collection of traders that devoting themselves to the discipline of going through the process. It has been an immensely useful exercise for us as a community. That also is the origin for everything: trading plan, backtesting, visual backtesting, simulations, journaling, feedback, coaching, and so on and so forth. So we're definitely not going to discuss those type of things here in the more basic foundational class. WTC1 class, you should be thinking about it as more of the knowledge on how to read the chart and the knowledge of the Wyckoff methodology. But it's an essential first step that you can't dismiss, and I'm not going to put you in WTC2 class without you taking WTC1. I just burned too many times when people became a huge distraction, in the way of how they would be in the WTC2 without WTC1. So we really, really encourage people to be on the proper path and to be properly educated and properly trained and coached. Okay, any other questions? You are welcome. Okay, well, with that, guys, I think that's it for today. Again, for those of you who are already in this class, most definitely read the article. And next Monday at 3 p.m. Pacific, we're gonna get together in a smaller class environment, and we're gonna start going through the accumulation. We're gonna go through the concepts of how does accumulation is being formed, how do we see accumulation on the chart, how do we time our entries, you know, the areas where we should be more active with our positions. And then we'll start talking about Wyckoff events that define the trading range, phases, and different variations on the price structure of the accumulation. That's going to be our goal. And you will have your first label and homework where I'm going to give you a bunch of charts and you will have to label them with the Wyckoff structure. On this note, guys, thank you so much for being here. It was a pleasure. For those of you who would like to rewatch some of the elements of this video, we're going to post this video on YouTube tonight. And with that, thank you so much. Happy trading, and I'll see you next Monday. Bye-bye.